All right, welcome in everybody. Thank you for joining us this afternoon or tonight, depending on where you're located. This will be our second and final AI circle for the month of May. Just letting some folks get in here. If you guys don't know me, it says my name at the bottom, but I realize I'm really bad at introducing myself on this. So I'm Leaf. A lot of you might know me just because of being a customer. If you are in the process of setting up accounts, you might have spoken to me as well. But just reach out if there's anything that I can do to help you guys with setting things up. Any questions, obviously, you're welcome to put them on here. That's about half of what we're going to go over tonight. So, without further ado, though, we'll introduce Mr. Kelly Korshak. Kelly, how are we today?
We're good, Lee. We're good. Hello, everyone.
Okay.
Tell me when. Let's see. Happy trading. I hope the last 2 weeks were good for everyone. We can do our disclaimer real quick. I'll actually do it, Lee, even though I won't read it this time. I'll memorize it and do it. First of all, the main thing about any disclaimer is to say that past performance is not indicative of future performance. Letting you know whatever happened in the past doesn't mean anything about what's going forward. And the other thing is we don't make buy sell recommendations. Everything on this AI circle is my opinion and mine alone. And iFlip itself may or may not share my opinion. Regardless, iFlip is if you need to ask for an advisor, iFlip can't advise you. You have to go find one for you. That all being said, then we can kind of get on with my opining.
Yeah, and just before you get to that, I was just going to let everyone know it will be a shorter AI circle tonight. And honestly, there's not a ton to cover. There hasn't been a ton going on since we met a couple weeks back. But Kelly, go ahead. I just wanted to set everyone's expectations that it'll be a little shorter than normal.
Thank you, Lee. Yeah, just because on a timeline for me. So we're just going to try to call this as close to the top of the hour as possible. We're going to go and do a quick rundown like we always do, and then we'll go into questions a little sooner than normal because generally it seems most people really care about asking some general questions about the market or the Flip software itself.
Yeah.
I'll talk about the markets and a little bit about our smartfolios and what they've been doing as well. So the market, I think everybody knows over the last 2 weeks, if you're looking at the chart, hopefully you can see it up there. I'll make it a little easier to read, hopefully. You should be seeing a chart of the Dow Jones, and there it is, folks. Since the last 2 weeks, we did put on a rally, and we just eked out a new high in the Dow Jones. So again, my least favorite index, but for all the problems that we had down here, in the bad economic data that came out, higher inflation expectations, the market, when it found out that that the CPI came in reasonable this time, even though it's still much higher than expected. Sorry, it came in within expectation, but much higher than the Fed wants. The market decided to continue its rally. But it's very noteworthy this time, and pardon my gesticulations here, is that the market went up with no volume. This is a market that I feel is being pulled up by secondary stocks. So when secondary stocks go up, it normally means it's towards the end of a bull market. So bull markets are generally led with blue chip stocks. Everybody kind of knows that. Those are the things we all know: Google, which is Alphabet, Apple, Meta, Netflix, those kind of things. Everything else from Bank of America and JP Morgan to Goldman Sachs on the banking side, and all the other things on the pharmaceutical sides, they've all kind of been going up. Those are the market leaders within their own sectors. But the secondary market, there's three sets in any market. There's the primary market, the blue chips. There's the secondary market, the marginally lesser known companies like CVS and things like that. They're very large companies, but they don't generally get the attention of the blue chips. And then finally, there's the lower end of the market, the Russell type products, where they're much smaller companies, companies that are $500 million or less in sales. Those are generally the third or tertiary share of the market. And those are generally the last stocks to rally. And it works this way because when people feel there's a bull market, you buy the most liquid things and known things first. Our analysts then start to say, hey, it's a bull market, so let's look at all the secondary stocks. Then they get you into those, or they highlight them. And then finally, the last group to normally rally is the Russell 2000, which are all the stocks underneath the S&P 500 and even below that, that are the last vestiges of places to put money. So I feel we're at least in the stage now that the major stocks have stopped going up, the ones we've heard of, the Mag 7, for example, et cetera, albeit some of them at new highs. A lot of the bigger ones are way off their highs. So let's get into it real quick. Here's the Dow, made a new high, backed off a couple of 100 points today, no big deal. Here is also a quick shot of the S&P 500. It's right at its old highs, down nothing or so today, very little change. It sits at a new high. But notice something about the way the market has gone up. Notice these little bars. There's no big bars, either up or down. They're just little bars. Why? Because there's not a lot of volume. The volume comes in the morning. There's a little bit more volume at the close, but there's nothing through the middle of the day. Very interesting. Let's look at the Russell. And look at this. The Russell, of course, was the weakest going before this recent rally. It did not make a new high where the S&P, Dow, and NASDAQ did. Here's the NASDAQ. There it is. New high. Interestingly, though, look, Apple, even though it rallied up, this is a definite sell in my world. I do not believe in Apple at this point. It's one of my favorite stocks, too. I think it really overvalued itself, and I still feel that the Apple is going down to 130. Google, again, it made a new high too. However, why? Because they finally offered their dividend. That's not a good thing. I mentioned that on the last AI circle. We can go to some of the other stocks. They're hanging in there, but they're off their highs. Here's Meta. Amazon is just off of its highs. I don't like Amazon here, yet I buy from it every day. I think I personally can hold this stock up. Microsoft, made a new high right here today. I'm not buying this until I see 370 on it, and I think I'm going to see it. NVIDIA earnings are out. I don't know where we are. Here, I'll post it. Of course, it did well. We're at 1,016. So, of course, NVIDIA must have beat. But again, I'm not a buyer of NVIDIA. This will be something I'm happy to buy at 50% off at some point in the future. Goldman Sachs came off of its highs today. Again, here's the stock where they were going to throw out the manager. But guess what happens? The market rallies $160 in literally 6 months. It's almost laughable. It was a company that was not having any earnings, and how it can add literally 70% in 7 months in a banking stock. Quite hard for me to believe. My favorite stocks, definitely, they're kind of flagging out to the downside in here. This is All Plains American, where we get the dividend. I really like this stock. I still do, but you can feel weight on it. And here it comes. It's the same thing with Exxon. There's weight on these energy stocks right now, almost like there's an anticipation that energy prices will go lower. That's yet to be seen. Let me quickly get into what could be causing this. And I always go back to this bond. Remember, it's interest rates. What made the last market rally when we talked 2 weeks ago was, of course, the CPI number, which comes out once a month, came out hot the previous month. You see this day here? That was the CPI number on a hot CPI day. See these 2 days here? This was the CPI number, or the CPI number in the following month, and it came out benign. So here it is right here. There it is. This date. So it came out within expectations instead of outside expectations. And that CPI number brought the interest rates, prices higher, which means rates lower, but it's trailing off. This, to me, still looks like a bear market. This is a bear market. And if we go further back, it's more of a bear market. interest rates have been going up since COVID. Now, going up from zero, I get it. But right here, the S&P was priced literally 10% lower. This little 10% rally in the bonds caused a 10% higher rally in the stock market, in the S&P. And if this thing starts to head back down, which I expect it to do, in other words, rates to creep up to a total of like 5% is what I expect on the 10-year note, you can count on the fact that at some point it will weigh on the major industrial averages in this country. Let's look at the dollar. Again, really not much going on. It's in a range. Remember 2 weeks ago, I'm going to remind everyone that everybody keeps thinking the dollar is going to get weaker. We're printing too much money. We have so much debt. And remember, if anybody recalls what I said, this is not just America. It's the rest of the world has done the exact same things. So no matter how much debt we've added to our federal balance sheet, it really doesn't matter because every other country has done the same thing. And that's why you see the dollar in this range. And this range is, as you can see, is going back more than a year. Right in here. Before that, of course, the dollar was much stronger. But now we're in a range. So when people say that's going to kill the dollar, we should buy gold or Bitcoin, I'm not saying not to buy gold or Bitcoin, but the dollar is fine and it's healthy and it's not going anywhere. So there's no bearish dollar that I can see out there. I see it as a range trade. I would be buying it if it weakened and I would sell it if it strengthened. So nothing to do here. I think let's quickly go into Q&A pretty quick. I'm going to move over to our balanced portfolio, the one in the middle. Based on the amount of red here, it doesn't look like it had the greatest day, but the balanced portfolio has been one of our best performing products over the last 15 months. I mean, relative to what we ask it to do. As a result, I mean, most of these stocks, as you can see, there's Apple, even though I don't like it, it still has a long position in it. Here's a stock, Burlington, that the AI got us out of, and I think you can all see why we got out of it. We were out of this stock a while back, right in this area here, and we remain out of this market. So, but if you look at the things that have done so well in it, here's old Eli Lilly. Look, new high today. McDonald's, we've been out, I'm happy to say, and you can see why. I mean, that's not something that looks like we should be in. But let's look at Merck. I think we should stay there, and we have. So we've had very few signals coming out of our machine learning component. And the reason is because the market is still holding in there on the A tier, or what we call blue chip stocks, which is really what both all this products in the aggressive, balanced, and conservative are all blue chip stocks. You don't need, as a reminder, everybody, you don't need to find the next stock so much as you need to find the right stock. And the right stock generally exists in the S&P 500. And that's why we focus on just the S&P 500. I see IBIT on this screen, which we did add a small component to IBIT to the balanced portfolio early this year. And let's see where that is. Well, as we all know, this is Bitcoin, basically back up towards its highs from a flagging lower. This looks like a flag. This is generally called a pennant in technical analysis terms. If anybody remembers their Edwards and McGee, then you can see that we move back up to its highs. Let's see where this takes us from here. I've been calling for 100,000 by the end of the summer. So let's, hopefully my call is right. I'm going to stick to it until I'm wrong. That's a pun, folks. Hope you guys were laughing behind the camera here. Let's take a look at AT&T and Verizon. Now, kind of interestingly, I'm starting to like both of these stocks, mostly because they're good on dividends. We rearranged our conservative portfolio earlier in the year to have a slightly smaller position in AT&T and put in a equal size position in Verizon. Why? It's called 6.7% is why. So here's a dividend. It's paying 66.5 cents every quarter on a basically a $40 stock. So here's how you do the quick calc, everybody. You take the 66.5 cents You multiply it by 4, and what do we have? We have $1.32, $1.33, 266. So we're going to get $2.66 a year for a $40 stock. Now that works out to be about 6.7%. By the way, could there be upside in this stock? Let's take a look. Well, we know it was lower all the way down to 30. Oh, but look. Oh, if we go back even towards COVID, this stock is literally, well, we could fairly say that it's about 60% undervalued from where it was priced before. To me, when I look at that, something paying 6.7, and I think it has a chance to maybe go to its highs, that would mean it would go up about 75% from here. But its lows, well, from 39 down to 30, so we would lose from $40, call it, to $30 a share. I'd lose 25%. But do the quick math. And I'm going to go to question and answer. And here's a way to think of things when you're buying stocks for yourself and you want income. If I feel that the stock can pay me a good dividend, and it's a well-known stock like Verizon, and it can pay me 6.7% for holding it, my downside is twofold. One, 25% down, it goes to the old lows. Okay. And then maybe it takes away its dividend. That's the other downside. But guess what? Those dividends never went, even at their lows. We can take a look. Look over here. Here's at a low. What was the dividend? It sustained 66.5 cents. I'm looking right there, folks, if you can see it. But on the upside, if I hold the stock, maybe my stock will pay me 6.7%, and maybe it goes to maybe it just goes to 50, which is literally 25% higher. That's only up to here. Could go all the way up to 70. But let's say it just goes to 50. I can make 25% and maybe lose 20%. But either way, I'm going to get 6.7%. This is why I hold these in the conservative portfolio and to a smaller degree in the balanced. So this is the way I think of things. And this is all beyond AI. This is just classic investment. What is my risk? What is my return? What is my upside? And what is my downside? You can do quick math and assemble a portfolio if you know the symbols. And so for today, really, again, even though the market made new highs, AI has not done a lot over the last 2 weeks. Nothing much to do there. The markets have rallied to make a new high, albeit it's been on high volume. So our portfolios have stayed largely the same, and they have not really moved through AI or otherwise much at all, other than up in value. And on that, Lee, let's go to Q&A.
Yeah, I thought it was fascinating what you started with about basically what's driving the market now. How long have we talked about the Mag 7 just keeping the market afloat? You know, it's been over a year probably straight.
AI. Who has AI? It's the Mag 7 have AI.
Right. But it's just fascinating to hear that obviously there gets to be a point where there's no longer value in that stuff to invest into, and then people look elsewhere is kind of my interpretation of what you were saying.
That's the correct interpretation.
Francisco had a couple questions. I answered one in the chat, but he said, has the AI been in cash as a whole? And then also, what's the pattern of AI being in the market? So I'll maybe take these questions slightly differently, but just Kelly, explain this first one. I said in the chat how, we've been in the SPY, for instance, we've been in cash, but we're actually invested in quite a few of the individual stocks. So just walk us through that as to maybe even how we could own, say, an Amazon and not the SPY.
Very simple. The Amazon, when we put products together there, AI is focused on generally a lot of streams of fundamental data. So fundamental data, of course, is not the technical data which you see on a screen like this. This is all technical data. It's the price movement of a stock. There's all kinds of derivatives of these price movements that we've seen before, everything from Fibonacci waves, and right here on the screen you can see these are moving averages, which is just manipulations of data. AI, however, is using fundamental data. So on a stock, It'll use fundamental data like its historical earnings, or it'll look at even the other aspects of it. It's its asset to liability ratio. It'll look at free cash flow. It'll look at the other things that you can find inside of like an Edgar's, which is where we get data. But if you look at the S&P 500, where do we get that data? Fundamental. The S&P data we look at are things you've heard me say before, which are things like credit card debt, or repossessions of automobiles, or Fed funds rates, things that come from what they call which is the St. Louis Federal Reserve. We call it FRED, F-R-E-D. It's basically where you get economic data from the government itself, or the U.S. Treasury. So the data that we look at for the S&P 500, fundamental data there, is extremely negative. And one of the major aspects of that is that our credit card debt is obviously to the moon. Another piece of that information is mortgages. Mortgages are at very high prices. Also, here's another thing. Mortgage defaults are rising. We've had data from the S&P 500. Normally, you can call this the wall of worry, that has been telling the machine to stay wary of the stock market. Yet the overall stock market as a whole, the S&P 500, that data is signaling a flat position. Whereas the individual stocks, look at NVIDIA. There's no reason really to be flat that stock. It's just that the buy signal that we would have is just, it's there, but it's a hard buy. Especially now, it's $1,000 a share. It's up over 100% on just this year. It's hard to buy it. So that's one thing that is the difference. That would be the explanation as to why the S&P may be out because of a machine, but why an individual stock, which is looking at different data, not macro data, only the data according to its own life, its balance sheet, it's the things that are relative to Amazon or Apple, is what it looks at, and those things are not as bearish as the overall market.
Sure. And just quick math based on what I was looking at earlier. I think, like, say, to give more clarity for Francisco, I think in balanced we're about 55% invested right now. Aggressive is in the low 60s, and I think conservatives around the same. So it's I'm just making the point that we're not in cash and everything, and there are still, right, like you said, things that we're comfortable owning right now.
Right. And by the way, in balanced, it's a little higher, Lee. The only thing in balanced that we don't own is the S&P. But yet, for example, the balanced last year for us was up 26%. If you own the balanced all year last year, which most people didn't, but if you did, it was up 26%. Well, the S&P 500 was also up 26%. But the balanced did that with only 70% of its money working. So the question, why? Because the balanced has a 20% position of the S&P 500, and it wasn't in that. But yet it maintained the performance of the S&P.
Right.
So I think this is a really critical point, and this is really how all portfolio managers work. If it comes down to, if you gave me $10 and I said, look, I'm only going to need $7 of your dollars, and I'll do the same thing as if you gave me all 10, you would give me 7, because really what I'm really doing is I'm taking advantage of the $7 in a different way to make it perform like it had 10.
Sure.
So if we do that, you think about it, wait, if I can only make $7 perform like it's 10, it's kind of an indirect leverage, which means the worst that could happen is every stock you had went to 0, you'd lose $7, as opposed to every stock going to 0 with your 10, and you lose all 10. There is, if you think of, there's a lot of math in there, but it's simple math. And hopefully, Francisco, you can kind of see where I'm going and how it's supposed to work.
Perfect.
Good question, by the way.
Before I get to the last one, you said, I think it was on NVIDIA, you said, you'd think about it if it was at 50% off. Is there any entry point that you might see on the AI getting us into the SPY? I'm sure it's not relative
Yeah,
to Zoom.
I can go to the SPY. Yes, we were very close to it, I think, but no, we couldn't get into the SPY until it was somewhere below. I would guess somewhere below 5,000.
So under 500 on the SPY or on the ETF side of it then.
Yes, exactly.
Got it.
Whatever
Cool.
the index is, the spider is just move the decimal over one.
Right. And then Jim had a question. How can I tell which part of IBIT is currently invested? So Kelly, just give a recap on the portfolio, maybe for people who haven't heard of it yet. That one's a little bit unique, not only in what it's invested into, but how it's managed compared to our other ones.
The way you can look is you can see there should be some free cash in your product to see if you're 100% long or 50% long. Right now, we're 50% long, although I think we're close to probably the possibility of being 100% long if the market can hang in here a little bit longer, because IBIT has had a good move up. Let's take a quick look at it. I have it in here. I always have IBIT somewhere available. So
Jim,
yeah,
the 50% buy and hold while Kelly's looking, that's what's in right now. The AI, I think he's saying might be close, but it's not in yet.
not quite.
So, and we'll always have the 50% in because it's a buy and hold.
Right. So wherever you buy it, the idea is we are always going to be long 50%, and the other 50% we want to be long on momentum. We do have momentum, as you can see right here. We've found it over the last week, and we should get a little more momentum will bring us up. I would like the trade if we get it, because this is the kind of thing that hopefully can breach these highs that we had before. And by the way, the market, just even though it feels it went up on low volume, all it takes is some data that might make the bond market happier. And I think we'll both get a signal to be in the IBIT for sure, because it will definitely, there is a relationship right now, no denying it, between the stock market rally and the IBIT. Notice when the stock market was going down the previous couple of weeks, so did IBIT. Stock market goes up. It took a while for IBIT to figure it out, but IBIT, of course, is just Bitcoin. It figured it out. Basically, when investors are putting their money in, it's like a rising tide. All boats are lifted.
Yep. Good stuff. Uh-oh. You might be frozen. Any other questions? I'm not seeing too many tonight.
Hold on.
I hear you just fine.
No. I know what to do now. I found the solution.
While Kelly's doing that, I'll just remind everyone, since we didn't formally go through the couple slides today, so we've already done pretty much 3 out of the 4. And just as a reminder, the Amazon gift card giveaway, we'll award it to the best question that is asked tonight. It's a little bit bare this afternoon so far, but we'll give you guys another minute or so to get any last questions in and potentially be our winner tonight. As we said at the start, we are going to wrap it up a little bit earlier than normal. We've got a couple other things to get done this afternoon before we move into tomorrow. But any last questions, you might be our winner tonight.
Well, if there's no last questions, which we normally try to finish this thing at 3, but we always go over. If I don't see anything pop up in there in the next 30 seconds, which is unusual, but I'm happy to give that one. So far, I'm giving it to Francisco because it's the right question to ask. Also, Jim's question is a good one. We should look for that. Hopefully, cross your fingers. I'd like to be long a lot more of that going into the summer. Sure. And we're getting close.
Pamela, here we go. What would you do with the ARK ETF if you lost a sizable amount? This might be good.
Find a capital. I could tell you my answer to that is find a capital gain that you can write off the loss. The problem I've always had with Cathie Woods is it's boom or bust. There is no in between. There is no money management. It's her perception of growth stocks. And those are really prone to huge volatility. There is a business for that, but I don't want to be in that business because boom and bust is just generally not a good business. Investment is a long-term thing, and it's not a short-term thing unless you're a trader. And so if I had a huge loss in Kathy Woods, I would take it, hold that loss, and look for things that could make you some profits. I'll give you an example real quick, and we can go to some other questions. Look, NVIDIA's been at 100% up. ARC, my last look of ARC was it was doing well. I'm going to quickly go to it. I don't like it. I don't like it. I have these here. Just by the way, just a 200-day moving average here. It's just a way to always look at basic things for something relative to where it was, say, almost a year ago. I would take my loss. The market is closer to a top, I feel, than a bottom. And if the market does start to go down, this thing will get hit. You're better off taking the loss, holding it, and finding something else to make your money in so you can use the capital loss on your taxes.
And she said it's in her IRA.
Well, then it doesn't matter. I still wouldn't own ARC. I'm not a believer in her product. It's too boom or bust with no risk management. That's just my own opinion. This is why I opine.
Sure. Good stuff. And then Jason had one, and he said, how safe is it to assume the AI is getting better each day since it is learning?
It's like anything else. That's actually also a very good question, Jason. But I know who you are. And yes, it does learn, but sort of like a child. It learns incrementally. And it's, by the way, it's very linear, much different than a human being. A human being, as they move through adolescence, they start to learn much, much more because they're more capable of learning. Machine learning can actually be done very quickly because things are trained over past data, whereas children and human beings cannot be. They have to see everything is new. And children can't be told that the stove is hot. They have to experience it for them to understand what it is. And the feedback is with a computer is absolute, but the feedback from another human being isn't. So it's safe to assume it definitely improves every day, but only on the margin.
Good stuff. Pamela, we might need to take this offline. Rollover is different than I think what you're asking. So let's just have a conversation about it. Because rolling money over into a Roth is a little bit different than buying or continuing to hold something or maybe even selling it. I think that's it. I know we're a couple minutes over. Kelly, I know you might have teased that Francisco was our winner tonight. Are you sticking with that?
I'm going to stick with Francisco.
Good. All right. Well, just trying to find his question. I know he asked a couple of them.
But
we'll go with, was it this one or the first one?
Which one?
It
was the question.
So is either has the AI been in cash as a whole, or
right? The difference. It was the explanation to understand why, for example, Apple could be in the market and the Spider out of the market, sure. And it's because each item is using different data. The Spider is a broad index, so therefore it uses broad index information.
Sure.
If I tried to teach the Spider to learn about Apple, why would I do that? So, by the way, that gets into a machine learning question, and this is why it's a good question. Machine learning is something that can be called self-directed. In other words, I don't allow the machine to learn from the internet. I tell it what I want it to learn. In other words, I self-direct and say, AI, I'm going to train you. I'm going to train the Spider on this symbol. Here's the data I'm giving you to learn from, which is coming from the Federal Reserve. I don't give it Apple's data from Free Edgar. When I train Apple, I technically could use the information from the Federal Reserve on the individual stock, but to me, it's more relevant for Apple to learn from itself and its own history. So I feed it information that is Apple centric. And that's why it's a good question, because it's good because it's answering what the difference is between self-directed AI and auto-directed AI. And by the way, there is a lot of auto-directed AI out there nowadays, and that's coming from like OpenAI and companies like that. And those are the ones that I think are kind of under the gun, and why Congress, for example, is nervous about that. So it leads to, the question is really good because it leads to a lot of broader questions about our society as a whole. And that's why you are
Awesome.
the winner tonight, Francisco.
Francisco, congratulations. I know you've been around a long time. I'm sure you've won one of these before. I just can't remember if you did or not. So you're probably familiar with the process, but just send us an email to mailbag@iflipinvest.com. Just either give us a screenshot or one of your account numbers, and someone on our team will get you that gift card. So congratulations there. Kelly, any final thoughts before I let them know when the next AI Circle is?
No, yeah, it's going to be the following week or 2 weeks from now. Yeah, by the way, folks, I'm kind of expecting the market to kind of back off a little bit in here for the next 2 weeks. So why don't we talk about that next week? So Lee, hold me to it. It's like market sits at about 39,670 on the Dow right now. 2 weeks from now, I suspect it'll be on the margin a little lower.
Sell in May and go away, right? Good stuff. Well, our next AI Circle will be June 5th, normal time as always. So we will see you guys in a couple weeks. And without further ado, have a great rest of your nights. And thanks as always for joining us.
Yeah, thank you, everyone. All